So hey everyone, in this video I'm going to walk you through the tool that we've built, the quantitative risk simulator for the stock portfolio, and also deep dive into what is the math underneath the model, why we chose the model, the reasoning behind it, how it works and everything like that. But before, let's just walk you through the tool and how it works and how to use it in the first place. So this tool right now is like a MVP version, like a very small prototype version of it. We can simulate around 500 to 5000 simulations for each and every portfolio, and with an investment horizon of around like 1 to 10 years. And yeah, so this is going to be the very basic model that we've built using Monte Carlo simulations and Geometric Brownian Motion, the model that we've used, not only assessing a single stock alone, but also use correlations to measure how the entire portfolio moves, because we know that stocks don't move alone. They have some kind of relationship with other companies as well. So we're going to take that into consideration into this as well. So yeah, right now we can enter the stock portfolio, we can add the weights, we can select the investment horizon, we can choose the number of simulation, the investment amount, the confidence level and everything. What's coming next is we're going to be adding multiple features like portfolio optimization using modern portfolio theory, which can help optimize your portfolio, not only assess the risk but also optimize it, and time varying volatility models, so also consider time as a factor in this, and then Black-Scholes option based derivative valuations. And yeah, we're going to use sensitivity analysis. We can add AI powered research assistants to just summarize your SEC filings, suggest portfolio improvements and stuff like that. So that's what's coming next. But for now, let's see how this works. Cool. So yeah, this is the very basic interface that we have, which is a Streamlit application, because I'm not a coder. I'm not into development. So yeah, so we have this at the sidebar that where you give your configuration. So we use these stocks for now. We have Apple, we have Nvidia, we have XOM, which is Exxon Mobil Corp, which is an energy company. We have Johnson and Johnson. We used gold, and we also used the treasury bonds, 20 plus year old treasury bonds. So yeah, very different kinds of stocks, very varying from different industries and different risk ratios for that. And these are the portfolio weights. So basically, portfolio weights are something like, let's say we have 0.2 over here, which means our portfolio consists 20% of our portfolio consists Apple stocks, and 20% has Nvidia stocks. 15% is our ExxonMobil Corp, and 15% is our J&G, that is Johnson & Johnson, and 20% is gold, and then we have 10% of our treasury bonds. So basically everything should add up to be 100%. That is the weights. And yeah, we chose the investment horizon 1 period, like the short-term investment kind of stuff, and we're going to simulate around 1000 simulations in this video. And the confidence level is 95%. I'll explain what this is, and we're going to use historical correlation. We are going to use how the stocks move together, and then our investment amount is $10,000 US. So run simulation. So yeah, this is what we got, the portfolio risk summary that we've received. We got an expected return of 10.65% after a year on the total investment that we of $10,000 that we put into multiple stocks in this entire portfolio, and the volatility is 22.58%. Like, volatility is the measure of risk, basically how much your portfolio moves with each and everything. So these two metrics are annualized returns and annualized volatility. So they play a crucial role in the formula of the Geometric Brownian Motion, and we're going to discuss how it works, how we're going to use. So basically, expected return would be, we take daily returns and we take the average of it, and what is how much percent of return. Volatility is basically the standard deviation, how much return is deviating from the mean return for every single day, and we analyze it by multiplying with the number of trading days in a year, that is 252, to get the annualized volatility. And these are the key important metrics that we have. The first one is VaR. With a 95% confidence level, we got 19.54%, and this is compounded value at risk, compounded VaR, that is 23.69%. And then we have probability of loss, that is 34.7. So there is a 34.7% chance that your portfolio will lose money, the amount that you put in, you're going to lose the amount that you put in. So basically that. So what is this 19.54% with a 95% of confidence level? So basically, in the last fifth percentile, the worst 5% of the cases that your portfolio can go through, like it has run 1,000 different simulations, 1,000 different simulations, like 1,000 different ways that your stock portfolio can go. In that 1,000 different ways that it has simulated, the worst 5% of the cases would go beyond 19.54%. So that means in the worst 5%, there is a 5% chance that your portfolio could lose more than 19.54% of its value. So that is what it's saying. And yeah, basically with a confidence level of 95%, your portfolio is not expected to lose more than 19.54%. That is, in our $10,000 investment, it would be 1,953. So if in 1,000 situations that happen in real life, the worst 5%, one of the worst 5% of the situations happen to come true, then you'll be losing more than $1,953. That is the worst case scenario, worst 5% case scenario. And what is this compounded value at risk? So if the worst 5% of cases happen, then what is the average value that you can use? So we have this big distribution of values, and then we cut it down to only the worst 5%. In that, if this happened, so in the small thing, what is the average amount that you can lose? That is 23.69. So if the worst 5% happens, the average loss would be 23.69%. That is $2,368.96. So this is the risk summary that you'll be getting, and this is the simulated portfolio value path. So basically, each and every path is a simulation. So there are 1,000 different paths in which your portfolio can go. It starts at here and it can go like this, it can go like this, it can go like this. It shows 1,000 different values. And yeah, this is the distribution basically. So yeah, this is the value, like how much percentage it could go down or how much percentage it can get. And these are the counts, like the number of situations or simulations that it can go up or beyond. And this red line over here is our 95% value. So behind this, or to the left of this, is our worst 5% of the cases that are there. We can see that majority of the simulations that we have run are above zero and above the 5%. That is, you're not going to lose as much as money. The probability that you are going to make a profitable return out of this is high. The number of chances are high. So the chances of making no return are also high. The chances of making positive return are also more than the chances of making negative returns. So this is what we can see. And below this is the worst 5% of the cases, number of how bad it could go basically. And this is the historical correlation matrix. So let's understand what is correlation. So in a market, stocks never act alone. Let's say there is a AI company, and then there is a GPU company, and then there is an energy company. These three are interdependent on each other, right? So if one goes up, the other one goes up too, because they are dependent. There is a correlation. Like all the tech companies are correlated to some extent. Like if one goes up, the other goes up. So correlation is, it could be -1, it could be 0, or it could be 1. If it is 1, that means it has a very strong correlation. That means, let's say if two companies have a correlation of 1, that means if this goes up, this one goes up too. If this goes down, this one goes down too. So the risk is very high if they are correlated. If the correlation is 0, the stock movements they're individual. They don't depend on each other. Like this could go its own way, this could go its own way. There is no interdependence at all. And there is a negative correlation, that is -1. That means if this one goes up, this one should go down, and this one goes up, this one should go down. So they are negatively correlated. For example, stocks like short-term bonds and the long-term treasury bonds, they are like negatively correlated, because if the stock market is good, then the treasury bonds fall. If the treasury bond market is good, then the stock market goes down. So it's simple like that. And we can see how the stocks that we've picked are correlated to each other. And this is the TLT, that is treasury bonds, and this is Apple. They're like, the correlation is like very less, 0.07. And then we have TLT and NVIDIA, we have 0.075, which is also very less. And then we have TLT and the Exxon Mobil Corp, that is minus 0.1, that they are negatively correlated. And with the Johnson & Johnson is also very less. With the gold, it's 0.37, which is a little bit higher because treasury bond, so basically treasury and gold market, treasury bond market and the gold markets are considered like a safer side. So when the stock market is unpredictable, most of the times it is, but when there is a risk over here in the short-term bonds, most of the investors, what they do is they take their money or investment from this risky short-term bonds, that is stock market, and they save it, they store it in the safer long-term bonds like gold and treasury bonds. That's what happens. So that is why TLT and the gold have a little bit higher correlation. And then yeah, you can see every single thing like that. Let's see NVIDIA and Apple. So yeah, the NVIDIA and Apple, the correlation is 0.67. The Apple and NVIDIA's correlation is 0.67, which is very high. They are both software and they're both tech companies. They move together. Like if NVIDIA, there is a 67% chance that if NVIDIA goes up, Apple goes up, and if NVIDIA goes down, Apple goes down. So that is a very high correlation that we have. And you can download your distributions, you can download the charts and everything. So this is the application that we have. And yeah, let's dive into how the math behind it works now. So yeah, let's start with the derivation of it. So let's see first, how the stock market moves. So we know that stock market, it doesn't follow like no smooth curves. No smooth curves, so it is very random. It moves zigzag, and it has like randomness. There is like too much randomness in the stock market. We never know how things go up and how things work. And the third one is the value of a stock, whatever it is, the returns can go negative, but the value of a stock, the price can never go negative. And we have an idea roughly that on an average, the market moves up, like as the time increases they tend to go up on an average. So that is what we have. And we know that the prices are multiplicative. They keep compounding. So each and every time that you invest, they keep compounding. So this is what we know. And so this is why we use, to satisfy all these conditions, we use something called as Geometric Brownian Motion, which is a part of stochastic calculus. Not differential calculus, stochastic calculus, because stochastic calculus deals with randomness, and this is very key in a stock market. So we're going to use stochastic calculus with geometric Brownian motion. So basically, the stock market price, which could be like S of t, let's say at time t, the price of the stock is S, and it depends on the drift. First thing is the drift, that is the daily returns, like how much expected rate of return. So we call it, we can predict that value with the historical data that we have. We can calculate the average annualized drift, which is mu. So we drift plus randomness. So this is something that we cannot predict, but this is something we know. Yeah, basically the expected plus random, and this is how the stock price moves. So this is the basic underlying part that we're going to be using over here. And yeah, so let's start with and it is multiplicator that we know. So the basic version of the geometric Brownian motion assumption is going to be like d of s of t equals to mu into s of t dt plus sigma into s of t into the Brownian motion. So this is the underlying equation that we're going to solve to simulate the geometric Brownian motion for the stock market. So at the time t, the small change in the stock price, mu over here is rate of return. The average rate of return is the mu that we have. So yeah, we get, let's say today as the price is x and the next day it's x 2x or something like that. We have multiple returns, like how much, if it's 2x it's 100% return. If it's, yeah, based on the return we analyze it and we calculate what is the average return for the entire portfolio in the time duration that we've decided. And this randomness that we're going to be generating is going to be generated through sigma, which is volatility that we've discussed in the before, like how much volatile is your stock portfolio, like how is the movement of the stocks over there. And this is derived through standard deviation. So you know the typical standard deviation in statistics, that is how deviated is your return from the mean of the stock. So yeah, and we're going to analyze it. So we, each and every standard deviation that we're going to get, the average standard deviation, and we're going to multiply it with root 252 because we have 252 trading days in a year to get the analyzed standard deviation, that is with the sigma. And we're going to multiply the stock value at time t everywhere because the stock market keeps compounding and it's multiplicative. And this dp of t over here is our Brownian motion. So this is what generates the randomness, the multiplicativity, so whatever it is. So yeah, that's this is our understanding, that is expected plus unexpected randomness is what decides the price of the stock. And yeah, let's see, stock prices are, how are we going to solve this thing? We cannot use differential calculus because it deals with randomness, so we're going to use stochastic differential equation, something called as Ito's lemma. So Ito's lemma is like your chain rule in your differential calculus. So for example, df by dt could be written as df by dx into dx by dt. So this is our differential chain rule in our normal differential calculus. And in stochastic differential calculus, it is something like, if we have the general equation like dx of t equals to a of t dt plus b of t into the randomness. If this is something that we have, then the chain rule with respect to the Ito's lemma is going to be like df equals to df by dx plus a into df by dx plus half b squared d squared f by dx squared of dt plus we have b into df by dx plus dw of t. This is what we're going to have. This is what we're going to apply to this and then solve this equation that we're going to get. So yeah, let's do that. And before that, let's keep in mind that our general equation, that is ds of t equals to mu into d mu s of t dt plus sigma s of t dt. It is multiplicative, as we've discussed before. And when something is multiplicative, it becomes difficult to solve in calculus because it keeps increasing exponentially, keeps compounding, you know, the compounding effect. So we gonna make it additive to make the solution. Solving it would be a little bit easier if it is additive rather than multiplicative. And how can we do that? By adding a log. So we know that log a of ab equals to log a plus log b, right? So that's what we're going to use. And yeah, so yeah, we're going to be using that, and we're going to apply log on both sides, and we're going to be converting it into additive rather than multiplicative and then solving this equation. So yeah, this is what we have, and now we're gonna apply the Ito's lemma to it, and we'll be getting something like d of f equals to df by ds into s, not x over here, and to mu s plus half d square f by ds square into sigma square s square dt plus df by ds into sigma into s into dw of t. Okay, so this is what we have, and now we are assuming that f of s is ln of s to make it go from multiplicative to additive. Just to make the problem solving a little bit easier, we're going to use this. So as we know that, then f dash of s would be 1 by s, and f double dash of s would be minus 1 by s square. So df by ds, d square f by ds square. We got that. And yeah, we are going to assume that because d of f of s would be d of ln of s of t over here. So to make it easier, let's take y of t is ln s of t, assumption. So we're gonna put it back again to make things simpler and stuff. We're gonna using this. So let's substitute. So d of f, which is d of ln of s of t, that would be d of y of t, right? Okay, and we can substitute this. This is 1 by s into mu into s plus half into d square f by ds square, that is minus 1 by s square, and sigma square s square of dt plus t plus again df by ds 1 by s sigma s dw of t. So this is what we have. So s and s gets cancelled, s square gets cancelled, and we have dy of t equals to mu minus half sigma square dt plus sigma dw of t. Now we're going to integrate it from time 0 to t, 0 to t, 0 to t, 0 to t, stuff like that. So we get y of t minus y of 0, again over here mu minus half sigma square, again t minus 0 is t, plus again over here we get sigma into w of t minus w0, and yeah, we know that y of t is ln of s of t, so this would be ln s of t minus ln s of 0, which would be mu minus half sigma square t plus sigma wt. And now we're going to be sending this over this side. So ln of s of t equals to ln s of 0 plus mu minus half sigma square t plus sigma w of t. And we're going to we have to remove the log because we used log just to simplify the equation to make it go additive and not multiplicative. So we're going to exponent on both sides. So we're going to use exponential on both sides, and we get s of t equals to s of 0 into exponential, that is e to the power of mu minus half sigma square t plus sigma w of t. Yeah, this is our geometric Brownian motion. That is, stock price at time t is equals to initial stock price at time t equals to 0 into e to the power of mu minus half sigma square t plus sigma wt. So this is our the part that we know, drift, and this is our random shock. So this is how we're going to be doing it, and it is exponential because as we've discussed that the price can never go negative, so that is why exponential function never goes negative, and then the model moves up on an average, so it keeps exponentially increasing, and it is multiplicative. It is depending upon the initial stock price that we've used. So this is it. But to compute it, so basically WT, that is the randomness that we're going to generate, that would be standard deviation of, like, between 0 to 1, like random values between 0 and 1. So this is how it's going to be. And yeah, so this is what we have. But in simulation, we're going to use this formula, that is S of nu, the stock price, S new equals to S old into exponential of mu minus half sigma square delta t, the change in time. The old, if we consider the old would be 0, then it would be t plus sigma into root delta t into z. So this is what we'll be using. So the delta t times z is, this is the randomness. Delta t is changing time, and z is random shock, volatility adjusted annually, randomness. So basically random number from standard normal deviation. It's going to give random numbers, basically. This is what this is. And yeah, that is how we're going to use it. This is for a single stock price. This is geometric Brownian motion. And to simulate the Monte Carlo simulation with this model, so let's say there is first scenario, we generate one random number, z1, okay, and to do the second simulation, it generates another random number, z2, and so on, nth simulation, zn. So basically for each and every different kind of random number, so in 1000 simulations we generate 1000 random numbers and compute 1000 situations. So these 1000 simulations are being derived through the randomness of the stock market. We know the volatility and the drift, that is the return, would be same. So yeah, so basically Monte Carlo simulation uses z's randomness and generates 1000 different situations. For every value of z, we get a new situation, new scenario of how your stock can move randomly, and that is how it is. So yeah, let's keep this in mind, and we know how Monte Carlo simulation works too. So Monte Carlo, the name came through the Monaco's, the famous casino, Monte Carlo casino, and the place also, because it's luck, it's randomness. We don't know. It's like casino, it's like gambling. So that is how the name came to be. And now this is for the risk of a single asset, right? For a single stock, or for a single asset. But we know that stocks never move alone. Stocks move together. So we need correlations. So that is where the correlation comes into the picture. So let's say this is our formula, right? Erase this. So yeah, let's we can use z, we can use epsilon is widely used instead of z, so in formulas and stuff, where let's say epsilon is random shock, just to keep in mind. So while simulating the correlated asset, like random shocks, whatever we're generating, they should also be correlated, or else they are not. If they are generated in a random way, that means there is no relation. So we need to figure out a relationship between two stocks to make it correlated, right? And we cannot correlate the returns or standard deviation, but the shock value that we're generating, the randomness, that is where we're gonna use the correlation in the picture. We know that epsilon is also between 0 and 1 at the same time over here. And let's say there are two stocks, stock 1 and stock 2. Okay, and then they have random shocks that are being generated epsilon 1 and epsilon 2. These are both randomly generated. If we just directly put them into the portfolio, then they are not correlated at all. So there is no relation between two randomly generated numbers for two different stocks. So, but we need a correlation between epsilon 1 and epsilon 2. So to make it correlated, let's first draw two independent and normal variables, that is x1 and x2. So these are going to be completely random. So this is what we're going to do. So we're going to generate first two random numbers, one for this, one for this. Okay, and then we make it correlated. So we have epsilon 1 would be x1, and then epsilon 2 would be derived through x1, that would be rho into x1 plus 1 minus rho square x2. So this is what we're getting, right? So rho is our correlation factor that we have, and yeah, this is how we're gonna get the correlation. But this only happens for two stocks. If we have two stocks, and then we can correlate them this way. But we have n number of stocks which are completely different. So we're going to use something called as Cholesky's decomposition in the linear algebra. So Cholesky's decomposition gives us like correlation for n number of stock portfolios and stuff like that. If there are more than two stocks, that is 310, we use linear algebra, that is Cholesky's decomposition. And so what we do is first we calculate the correlation, that is rho, and then create a correlation matrix. So the matrix that we've seen. So basically how it's going to be like is, so let's say the matrix is sigma, and we have rho 1 1, rho 1 2, rho 1 3, rho 2 1, rho 2 2, rho 2 3. Correlation between stock 1, stock 2, stock 1, stock 2, stock 1 and 1, stock 1 and 2, stock 1 and 3, 2 1 2 2 2 3, and 3 1 3 2 3 3. So this is what we have. So we know that the correlation between two stocks which are similar, apple and apple, is 1, because they both are same basically. So we know that our diagonals are going to be same. Rho 1 2 2 1 is same. So we have rho 1 2, rho 1 3, rho 2 1, rho 2 3, rho 3 1, rho 3 2, and basically these two are same, these two are same, these two are same. And yeah, and how are we getting this rho? Basically the rho we're gonna get with covariance, basically not variance, covariance between stock 1 and stock 2, rate of returns. So this is the rate of return of stock 1, this is the rate of return of stock 2. Between their covariance is what we get rho, that is correlation. So yeah, now we have to derive R, that is Cholesky's decomposition, and we're gonna only use the lower triangular values of sigma, and we're gonna do it. So to generate random value of R for x, so basically we need sigma, right? Sigma matrix for all the different stocks that we're using. Here we choose 3, so sigma would be R times x. So if we get R would be equals to something like 1 1 0 0, 2 1 2 2 0, 3 1 3 2 3 3. So only the lower triangular matrix we're going to be using, and then x1 x2 and x1 x2 x3. So this is the equation. We get epsilon 1 epsilon 2 epsilon 3. So this is the equation that we're going to get. So these are the actual correlated random values that we will be generating. And now if we put it all together, we will have s1 would be equals to s old into exponential e to the power of mu minus half sigma square delta t plus sigma root delta t epsilon 1. And s2 would be s old into exponential into mu minus half sigma square delta t plus sigma epsilon 2, and so on. Sn would be s old to e to the power of mu minus half sigma squared delta t plus sigma delta t into epsilon n, sorry. Yeah, so this is the matrix that we're going to generate, and yeah, in the end we're going to find the metrics. We find the average rate of return that we've seen in the risk summary. That would be annualized average rate of return mu, and then we get average volatility, that is annualized sigma, average sigma. Basically average standard deviation into root 252 is what we get, annualized volatility. And then we calculate all these things, 1,000 different simulations, and after 1,000 different simulations we see three metrics in our model. First one is VaR, value at risk at X% confidence level. So we generally use X would be 95% in most cases that investors assess the risk of the portfolio. So basically we see how many portfolios are going down, how many, like in the 1,000 different simulations, it analyzes how many portfolios are going into losses, how many situations are going into the profits, and then it assesses it arranges them in the order and sees what are the last worst 5 case scenarios. Okay, like how many situations are in the worst 5 case scenarios where the losses are like very big, and value at risk is basically that. So in the last 5%, if it's the 95% confidence level, that means 5%. So in the last fifth, what is the fifth percentile? What is the fifth percentile that your stock portfolio will lose its value? So we saw, I guess, something like 12%, right, before. Yeah, something around 12% is our 95%. That means your portfolio can lose more than, what is the chances that your portfolio can lose more than 12% of its value? That would be 5%. And yeah, let's say this is the chart, and we saw this right, like this is the last 5%, and if we zoom in on this last 5%, only this, what is the average, like if this situation happened, like forget all this happened, the worst 5% that could go wrong went wrong. So what is the average that you could lose? That would be CVaR, compounded value at risk. So the average, so if the 5% case scenario happens, the value that you can lose on an average would be some for the portfolio that we assessed, we got something like 20%, I guess. Yeah, this is it. And then we got another one is probability of loss. So what is probability of loss? So basically, out of all the situations that happen, what is the probability, like how many situations are in the losses and how many situations are in the profits? So probability of loss would be like the number of losses occurred by the total number of situations that have been there. That would be somewhere around 30% that we got. So for each and every portfolio it will be different. So yeah, this is how the geometric Brownian motion is derived, and we again used Monte Carlo simulation by changing the epsilon values, randomness over here, and then we correlated the assets using Cholesky's decomposition of linear algebra, and then we just got the metrics and everything. We calculated everything. We calculated the average, and we showed the risk summary and the distribution of charts and everything like that. But there is a drawback in geometric Brownian motion, and the geometric Brownian motion, the drawback is it assumes that volatility is constant. So the sigma, whatever volatility, it is constant. If a stock value goes up, it goes up step by step. If it comes down, it comes down step by step, step by step, step by step. But in a real life stock market, there are cases where there is a jump in stock price. That it's not constantly going up like in a slow trajectory, but it's just a single day jump. One day it's like this, and the next day it's up, or a single day down for like this date is here and it just fell down. It could happen through various different reasons, like we don't know, because there are a lot of factors that affect the stock price. Like it could be the momentum of investors, or it could be just a word or a news report or an article that company releases, or a new project being launched. It could be anything. We don't know how the market moves. The sentiments play a crucial role. That is why we say it's random, because we cannot predict that many number of humans how they think, their movements and stuff like that. So yeah, geometric motion neglects this. It assumes that volatility is constant, which it is in most cases, but there are cases where, and yeah, even these cases are not less, I would say, like where the stock market just jumps up one day or it crashes the next day in a very short period of time. The stock market or the crypto market, like they are very unpredictable. So this is the one drawback that I've seen in the geometric Brownian motion. So we're gonna use other models, we're gonna experiment different models, we're gonna add other features, we're gonna use AI to make sure this application is also giving you all the right things, comparing it to the market, what is happening in the market, summarizing everything for you. And we're gonna try, because we already use geometric Brownian motion, we can also use the Black-Scholes option derivative valuation. So you can not only assess the risk of a portfolio, but also do your valuations and stuff like that. Yeah, the next parts are going to be interesting, I guess. So that's it for today's video, guys. I think it is clear, but yeah, cool. So see you in the next video.